Good morning. Welcome to the macro snapshot for Tuesday, July the 29th, 2025. Let's just look at and see how the market has digested the European trade deal between Europe and the US. Overall, after sort of initial sort of optimism and following some, quite negative comments from the French leadership and the German leadership and leaders of sort of industry in countries like Germany, which think that it's a very one-sided deal, the market has had time to digest the details, and it's come up with a fairly negative conclusion that this really doesn't do much for Europe and in fact favors the US. And we see that, for example, if the European Union is obliged to buy, according to the deal, 750 million, no, was it 600 million, $1 billion worth of US sort of arms, that could be a negative for some of those sort of German armaments makers and European armaments makers. So it's not necessarily a sort of a positive. And the other thing as well is that, one of the main industries, for example, of Germany is car exports and auto part exports. And now they're being subjected to a 15% sort of import duty or tariff from the US. That's not great news. Now, one could argue that it's not 18%, it's not the originally sort of mooted sort of 30%, but the reality is that imports on sort of European goods are going up substantially, which overall, even if, I've read numbers that some people saying it's maybe going to be a hit of, 50 basis points to sort of European growth, but nonetheless, it's not wonderful. And one of the main beneficiaries was the US dollar, which we can see for yesterday. So let's have a look at this. Is that quite an interesting level? Now, let's keep in mind that, the US dollar has gone down about, I think it's about 12% since the top here. So it's still very much in a downtrend. Although what we can see is that the 20 and the 50-day moving average are starting to flatten out. And this could be the beginnings of a basing formation here, because it did fail to make a lower low. And we're now starting to sort of push up and test sort of new levels. Although this is quite critical. You see the first little test here, which has failed at 98.90. That's a little failure here. Probably a more significant test is going to be at this level here at 99.33, which is the recent kind of swing high. The other thing I just want to point out, if we look here, just a couple of classical technical indicators, you can see here at the top of the Bollinger Bands, just on the daily. So there could be a little bit of resistance here. If we also just look at just want to put a quick fib, you can see that just if we go from this most recent impulse here, and we just see where this has got to, we can see here that we've gone above the 38-day 38% sort of retracement, but not yet the 50%. So I think here this is going to be quite critical just to see if there's more sort of energy to the upside in the US dollar. And of course, we do start to get data, and we have the QRA coming in tomorrow morning, and then the Fed, et cetera, et cetera. So there's a lot of stuff happening, which is going to determine the future of the US dollar. So maybe it might be a good 24 hours here for a pause. But having said that, if you look at some of the other important sort of currencies, if you look at the euro, also at quite a critical point here. It's now at the 50-day moving average. It's broken down below its, at this most recent impulse, it's broken down below its 68% fib. So looking a little bit weak. And again, though, if you look on, let's say, something like the Bollinger Bands, you can see that that's also just testing, it's just extended outside the Bollinger Bands, which it hasn't actually done too much lately. If you just go back, you can see that in general on the daily Bollinger Bands, it doesn't like to spend too much time above them, generally retests back inside towards the middle. So it wouldn't surprise me if the euro just does come back a little bit of consolidation. Let's keep an eye on that. A similar kind of situation if you look at some other currencies. You see against the Swiss franc, Aussie dollar, the US dollar sort of pushing a little bit higher here, but again coming up against sort of the outermost limits of the Bollinger Band. Similar kind of situation here with the pound sort of extending, and also with the Japanese yen. Has a bit more to go with the Japanese yen, so maybe some of the pressure or the US dollar strength could go there rather than, let's say, with the euro or the Swiss franc or the pound. But overall, a pretty good day for the US dollar, and that was reflected in just some of the way some of the assets reacted. That the European assets, if we look at the Euro stocks, they've come back a little bit this morning, just a little bit. But you see they had a pretty much of a down day yesterday. If we look at the DAX over in Germany, you can see they had quite a heavy sell-off yesterday. And so all in all, a bit of a risk-off day. And if we look at the the bonds, let's just look at the German bonds. Let's say, for example, the 10-year, we can see that it had a risk on, risk off kind of day yesterday, just reacting against that sort of negativity. So quite a lot of negativity. There's talk now that there's still not a deal with the Chinese, although it looks as though Trump is going to extend that by sort of another 90 days for negotiations. And clearly he's signaling his viewpoint because what was, I think, quite unusual, very diplomatically unusual, was that the Taiwanese president was scheduled to do a sort of a stop in the US, sort of a layover. I think it was in New York, and Trump actually did not give the Taiwanese president the ability to have sort of a short stay in the US as a sort of as a visa stay, which was a bit of a slap in the face to Taiwan, and essentially was symbolically a little bit of a diplomatic gift for the Chinese, the mainland China, saying, hey, we don't want to upset the trade negotiations at the moment by looking to be too pro Taiwan. So that was an interesting little thing on the side. Just in terms of the reaction to the trade deal, instead of euphoria, we also got, as I say, just keeping an eye on oil here. You can see that what's happened in oil. We did get a bit of a pop yesterday, and it's easy to ascribe that to sort of, some kind of sort of happiness about the potential sort of trade deal. I think it's more just what's going on with sort of Russia, because yesterday Trump also came out saying that he was very unhappy with Putin, and that I think it was like a 50-day window for a ceasefire in Ukraine. He decided that he wanted to see action in 12 days, action in the sense of some sort of a kind of ceasefire or at least diplomatic activity. Obviously, the Russian Prime Minister Medvedev came out and basically told the Americans to shove it and mind their own business. But Trump did come out with the idea and let it slip that there could be more severe sanctions. And so, of course, the oil market is looking at that and thinking that maybe there could be some production curbs or at least curbs on exports coming out of Russia, which could tighten global supplies. So I'm not sure whether this has got to be more than a 24-hour sort of pop. I mean, the thing is, if we look here, I just want to look at some of the time spreads and calendar spreads on oil, which we haven't looked at for a few days. If we actually look here at let's say CL1 versus CL6, this is the front contract versus 6 months out, and you can see here that when we had the kerfuffle between Iran and Israel and the bombing and everything, you see that time spread there went out to about $7. So that's a bit of a sort of geopolitical risk premium. Since then, it's come off, and it has come down now down to about $2.34. But you can see from a historical perspective, it's not too bad. It's certainly, for example, higher than it was back in May. And if we go back, how far back can we go back here? Let's just let this load up. Okay, it was a little bit higher early May, but what you can see is that it's relatively stable. And if we actually look here at the curve itself, so this is the WTI curve, you can see that it's still very much each dot, of course, representing a 1 month. Here's the spot, or actually not the spot, here's the first contract. You can see that between, let's say, the first month going out to the next 3, 4, 5, 6 months, that it's still very much in a contango, a backwardated state, a very strong state of backwardation, which ordinarily sort of indicates, quite solid and robust demand in the physical market. And so you'd have to say at this point, there's no real reason for oil to collapse in price. I would say that, with some geopolitical tensions and a relatively, I would say, sort of a stable global economy, not a growing really sort of economy, but a stable economy, because we still obviously have tariff problems. Oil is probably just happy being stuck between the two and staying in a trade range. And that's more or less what we're seeing if we look at the chart for oil. It just doesn't seem at the moment to be a lot of money flow going into oil, and it does just seem to be stuck with pretty low energy between, let's say, early 60s and sort of mid 60s, somewhere in about a $4 or $5 sort of range there. So not a huge amount happening there. Now, as I said, we do start to get quite a lot of data starting with today and then going on towards the end of the week. We have some earnings today. We have Visa. We have a lot of earnings, but one of them is Visa. That's going to be interesting just to see the commentary about sort of spending, because obviously Visa as a global credit card, also in the US, of course, they will give us a little bit of insight into sort of spending patterns. Also, we might keep an eye. I'm curious to know about delinquencies, because I've been reading some stuff basically saying that the level of credit card delinquencies is starting to rise, especially amongst the lower quartile of income earners. So could that be a sign that there's some sort of cracks in at least that sort of demographic? So we'll get some information today from Visa. Also, after the bell, we get UPS, of course, the big courier company, logistics company. UPS, like FedEx, are always kind of interesting because they tend to sort of have a good pulse on sort of economic activity. So let's see what happens with UPS and whether they have a good outlook about this economic activity and whether they say that Q2 was simply there was a lot of indecision, but they're now seeing things pick up, or they're still seeing that indecision. That's something to be looking out for. Other thing today, which we get at 10 o'clock, we get some labor market. I don't know if we say data, but let's call it sort of information. So we get the JOLTS numbers. And if we look here, let me just bring it up if I could find it. So we get the whole JOLTS. So of course that's job openings and labor turnover. So it's like and what we've been seeing here, if we actually look at some of these, is that this is I would say it's showing a solid market, a labor market, rather than an accelerating market or a deaccelerating market. So if we look at the job openings, just look at the let's just see the actual levels of the job openings, and you can see here that they had been going down. So you could say that, but technically you could say they've been going down since 23, and you could argue this is quite a noisy number. It's not the best sort of data. And last time it went up a little bit. So you could argue that this is stable. You certainly couldn't look at this graph and say that things are horrible. You could say that gradually it's been grinding down for the last couple of years, but that's also on the back of a lot of labor shortages of workers and whatnot, and you could say that looks stable to me. So that's the job openings. And then if you actually look at the quits level, which is a level of sort of confidence, that's always sort of interesting as well. And the idea here is that if more people are quitting, of course, they're more and more confident about getting maybe a higher income or at least finding a job relatively quickly. Now, again, you could say that the quits level had been declining, but again, you see that over the last 4 or 5 readings, one could argue that that's actually even going up, which would indicate confidence amongst workers in the labor market. And then finally, if we look at the layoffs level, so this is people who have been essentially fired, we can just let that low level. Obviously, with COVID, that was a bit crazy. So let's just bring it in a little bit, more for the last couple of years or so. And again, you can see it's a relatively noisy number. And now, is the layoffs level, is it actually going down? Maybe it's actually going down a bit. It was up, down, but it does seem to be relatively stable. Certainly, the point I'm trying to make is that if you look at all of the JOLTS numbers for the last 3 or 4, 5 months, they're not horrible. Some months they're going down a bit, some months are a bit more positive. So it just is pointing to a lot of the labor market data we're getting, which is essentially saying that companies are not really hiring a lot of people. So it's not a really strong labor market, but companies are not really seeing the necessity to fire people either. So it's sort of in an equilibrium. Obviously, we have ADP tomorrow. We have initial jobless claims. We have non-farm payrolls on Friday. So we do have a lot more information coming. But just at the moment, it is looking like a market which doesn't really justify the Fed being particularly dovish and cutting rates, because the labor market does seem fine. Secondly, at 10 o'clock, we do have the conference board. Sort of confidence, the consumer confidence levels. As you can see here, the market is expecting 96, so a little bit higher than last time, and that could be on the back of sort of a stock market still at elevated levels, and as I say, the labor market doing pretty well. So let's just see here about expectations, present situation. That's second tier data. I don't think that's going to be supermarket moving, but it's definitely something to keep an eye out for. Another thing we get today, we get at 7 o'clock. 7 o'clock, we get the 7-year auction at 1 p.m. Yesterday we had the 2s and the 5-year auctions. The 2s was actually okay. The 5s was a little bit weak. So it's going to be interesting today to see if there's a little more weakness in global demand, international sort of central bank demand for the 7-year, so the belly of the curve, the 7-year auction. That would be, for me, not so surprising, just because there's a lot of uncertainty with all the data and everything coming up, and also the quarterly refunding announcement. Now, yesterday we did get the quarterly refunding announcement. The overall numbers showed just a little bit more sort of borrowing being necessitated by the Treasury, but they explained that in their statement, and which, by the way, was quite political and quite sort of positive, the statement about the economy. They basically explained that by saying that they needed to top up the TGA, which is a general accounting kind of fund. So that's not really a huge amount of information. Really, the key information is going to come tomorrow. That's Wednesday at 8:30, where we'll get the whole composition about whether they're going to issue less coupons, more coupons in 2026, if they're going to sort of do some buybacks from the market for those low liquidity off the run bonds, fund those with bills, etc., etc. We'll get a whole sense of what's going on there. So that could be quite market moving at 8:30 tomorrow. Finally, guys, just want to have a quick quick look at just a couple of the markets here. You see the equities, VIX still at very low levels. VIX really sort of going to sleep here, which almost seems a little bit too sleepy. I wonder if that's going to sort of pick up during the end of this week. But you see here, VIX just very, very low, grinding down to sort of 14.5. Ordinarily that's going to be a small positive for the equity market. And you can see here the equity market continues to grind higher. There was a little bit of sort of negativity just on that sort of the tariff deal with the Europeans. But again, that would be seen finally as being a bit more pro-American or balanced more towards Americans. We are seeing this at the top of the Bollinger Bands. It's the same thing on the monthlies, especially. It looks overextended on the Nasdaq. But the point is, this can keep on grinding up, even though it's still a little bit overextended. And again, I think all the earnings we get, obviously we get some big tech earnings tomorrow and Thursday as well, could possibly push this higher. It's not, that oversold and as overbought at this point, and this could continue to grind up as long as we have a low VIX and a president who, if we just step back a little bit, I mean, I think the market has understood that this is a president who is flexible and is capitalist, and therefore this is a president who is able, to control the levers of power and the markets. And if he sees things are not going too well, he's quite happy to sort of make some adjustments and pump the market a little bit. So I think in a certain sense, yes, there is a bit of a Trump put. Okay, guys, we'll leave it there. We'll get the data from the JOLTS and the conference board, the consumer confidence at 10 o'clock. We also has, as I say, the earnings coming out from Visa and especially UPS I'll be looking at. And of course, no doubt our friend in the White House will be tweeting all day. Okay, take care, and we'll continue this tomorrow. Thank you.